Hello, hello. With Microsoft stock continuing to crash lately, it's a good opportunity to take a fresh look at the company. Now, this has been going down in the past couple of sessions or three sessions, as you'll see here. Actually, a couple of sessions, frankly. It used to be like 240, near 240. Right now, it's sitting at 222. As again, the whole tech market seems to be going down right now. Tech companies seem to be sort of like having a mini crash these past few sessions. Now, if you take a look at the 6 month chart, you will kind of see that we're approaching the low of the 6 month period over here. In the 1 year chart, you can kind of see it as well. We are approaching the lows of what the company has been in the past the past year. So this may be a prime opportunity. It's down about 31% from its 1 year high. But is it cheap enough? This is what we're going to be examining in this video. Now, the P/E ratio of the company is sitting at 24 and the price to free cash flow at 25.5, which are fairly interesting here. Now, obviously, as this goes down more, and if it goes down even more, it's going to become even more appetizing. But 24 and 25 for a company of Microsoft's caliber doesn't sound bad at all. Of course, we cannot be basing our buying decisions just on these two numbers. We'll have to examine other things about the company, and we will in this video. But it's an initial first view here that looks interesting. Obviously, we would love to get something that's less than 20, but we are willing to pay a little bit more if we're talking about quality, and Microsoft is definitely a quality company. They are buying back some shares here as well. As you'll see, they keep buying shares, they keep buying back shares and retiring them, which is basically great for stockholders already holding the company. And in terms of the total liabilities, not many over here compared to the free cash flow that they generated last year. Now, the 5 year revenue growth has been increasing. So the company pretty much keeps growing at a very nice spot here and at a very nice rate. Very, very good to see for a company of that size. And net income growth that is also going up, free cash flow growth also going up, and total equity as well. So it is a growing company, a huge company that is still growing nicely. Very nice to see. And obviously, being a software company, fantastic margins as well. Now, these kinds of margins, as they are so high, people want them, so people are salivating over them. So investors like these kinds of margins, obviously, and this is why you could be getting prices that are a little bit excessive here. So, and it could make sense to be buying a company of this caliber at a little bit of a higher price. Now, you don't want to overdo it, and again, we're going to examine what the correct price could be. But it's worth noting that it's not the same to be buying a company like Walmart, which has very low margins, for example, and a company like Microsoft, which has tremendous net income margins here. It's a completely different story. And the returns of a company are looking great, and no debt, pretty much very little debt compared to equity, about 35%, as you'll see here. Now, the company does pay a little bit of a dividend yield. That's very little, so it doesn't take a lot of the free cash flow that they generate out of the company. It doesn't extract too much. It's about 1.1%. And it's not negligible by any means, and you will see that the company has been increasing it for a while now. It's an interesting combination of a company that is still growing and also paying some nice dividend here, which seems to also be growing at a very nice pace, a very high pace. If you take a look at pretty much the chart here, very nice to see. Now, what about the financial statements? What has the company been doing? You will see that they have started generating about $110 billion back in 2018, and now they are getting to $200 billion, which is an insane amount of increases here, right? 14%, 13%, 17%. For a company of this size, it's very, very high, this kind of growth here. For a company that is already making $200 billion, that's a lot. And the analysts are actually projecting similar growth for the company. We're looking at maybe not 17, but you will see something like 13, for example, from many analysts, if you take a look take a look at it online. Something around 7 to 13, which is still very, very solid for a company of this size, of course. And the net income here, 16 billion to 72. And this is, of course, out of the ordinary. This is a tremendous amount of net income growth, especially back in 2019, they grew at a tremendous pace. And obviously, when you are growing at this pace, your assets are growing too. And the total equity basically doubled from 82 billion to 166.5 billion, a company that is generating tons of money here. And this is fantastic for their operations here and what they are doing business-wise. And in terms of the net income, you will see here that again, that has been increasing, and obviously it causes an increase in the operating cash flow, because this is where the operating cash flow begins, the net income. And after the adjustments for mainly some depreciation, amortization, and stock-based compensation here, these are money that is added back because these are not cash expenses, so they are added back to the operating cash flow here, and they are generating an 89 billion in terms of operating cash flow, which if you take it to free cash flow after extracting the capital expenditures that the company pays, this value over here, you're going to see 65 billion, starting from 32 to 65, about the same amount of growth, doubling their free cash flow, the same thing that they did with their assets, for example. Great thing to see as well. The company has been increasing their free cash flow at a tremendous pace as well, in the past 5 years, that is. And they're spending about $18 billion in dividends. And as you'll see, 65 is what they're making, is what we examined earlier, about like 30% of their free cash flow, which is more than fair here. And in terms of investing activities, it's mostly capital expenditures, again, as you will see here. Investments in property, plant, and equipment, the gist of capital expenditures, and some purchases of investments, some selling. There has been a little bit of selling here in the past year, for the most part. They seem to be a net seller for investments, Microsoft right now. Okay, but what about the company's evaluation here? What about our stock evaluator? What about our DCF model? How much is the company worth? If I wanted to buy this today, what should I be paying? Is $222 good enough, or is it expensive? Is it cheap? This is what we're going to examine now. You can see here in our handy little table, the company has been doing about 17% on average. The revenue growth has been 17.17 in the past few years. That's the 5-year average. However, we're going to be going down a little bit because we are expecting it to go down, but not in negative territory or much lower. It's probably going to be something like 7, 9, and 11, what I want to try here. And it could be even more, a little bit more for the company in the upcoming 5 years. This is playing it a little bit safe. And in terms of net income margins, the company is doing about 37%, and it seems to be keeping up with it. And also, it actually seems to be speeding instead of going down. You can kind of see it here, 30, 36, and 37 over here, pretty much. So I'm going to try something like 34. Whoops, not 24. I wanted to try 34. Let's go 35 and 37 here. Let's just go with a little bit of extra growth here, because it seems like the company has been in an upwards trajectory. This may be pushing it a little bit, but I just want to see what we're getting. And the free cash flow margins that the company generates, 100, 102, 91, 90, very casual, very usual, 90, 100, and let's go 110 here. Again, this is maybe pushing it a little bit. Actually, I'm going to go 105. And the annual return, 13% over here is what we're seeing. Now, you will notice that the free cash flow margin has been an average of 115%, but remember, sometimes there is the odd one out, which affects the average. And so in this case, you can kind of want to see what the company has been doing in the past, in the other years where things are actually more balanced. So over here, 90%, 102, even 105 may be a little bit much. Again, this is going to be an outlier, pretty much. This is going to be a little bit aggressive. So let's hit calculate and see what we get for an annual return of 30%, which is what we would be asking for. Now, the low that we're getting here with revenue growth of 7% and 34%, 90% of the free cash flow margin, which is about 90% of the 34%, exactly, not about. And this gives us a $146 price to pay today for the company if we're expecting a revenue growth of 7% and all these values to become true. Now, I think this is conservative. So, frankly, I think this one is more close. It's actually closer to reality, to what the company is probably going to be doing in the upcoming 5 years, potentially. Now, for this one, we're sitting at $181. And for the high one, which is a little bit aggressive, this one was a little bit aggressive, we're sitting at 218. Now, this is aggressive, but it's not out of this world. So it could still happen. It's not out of the question that this could happen. Maybe the free cash flow margin is a little bit much here. But other than that, the other values could definitely happen. And so now we are sitting at price ranges that are not very far from this one, especially the high one. And remember, it does make sense to pay a little bit more in order to get a company that is better, that is actually very, very good, and pay a little bit more than actually paying much less and get average companies. So it's always better to be potentially paying a little bit more, even if it's a little bit expensive, in order to actually grab some of the value from the markets. Now, is 222 a good price? I think it's potentially an interesting price, but I would be willing to wait it out a little bit. I think there is a potential for the company to still go down a little bit. But for somebody who is, obviously a value investor, I could definitely see somebody adding a little bit of Microsoft here, even at these levels. Yeah, again, it's paying a little bit more than what you could be asking for potentially. But snatching value at this price is definitely, again, not out of the question. if you also mind the fact that the company has been having all these amazing things on the side. Remember, these things matter. The company is still growing. It's a huge company, huge amount of money, no debt, and great margins. All these things matter, and getting a little bit of paying a little bit of extra makes a ton of sense here. Now, what would I want to pay? I would love to be able to pay something near this, like maybe 180, 190. Would be tremendous. But this would actually mean that the company will go down significantly from these levels. And so, if you are buying maybe it's, let's say, a lot of $10,000 worth of Microsoft, it may make sense to actually buy some, maybe $2,000 out of this $10,000. So it won't make much of a difference if it goes like to 200 here or 210 if you just buy 1/5 of what you wanted to buy. So as this goes down, it may be an interesting possibility for averaging down. But it is actually a potentially very, very interesting entry point here for this company, looking rather nice. And yeah, again, this is a fantastic company that everybody would love to have in their portfolio for the right price. And we may just be getting there, if not now, maybe soon, for depending on what people want really and how much they're willing to pay. But do let me know what your price is for Microsoft. Leave a comment below. I'd love to hear what's your price. I may actually set it as a poll also. I'm interested to see what people think. This may make for an interesting poll. Remember to leave a like and subscribe as well. And I'd love to see you in our next video. See you soon. Bye-bye.